All right. Hello and welcome everyone to our latest Macro Insiders webinar. I'm Kim from Real Vision, and today I'm joined by Raoul, co-founder and CEO of Real Vision, and Julian Brigden, co-founder and head of research at MI2 Partners. We're going to be taking questions at the end of the webinar, so please use the chat on the side to ask those questions. And let's get right to it. Raoul, Julian, take it away.
Great. I mean, look, Julian and I we were talking yesterday for Macro Insiders. There is so much going on right now, Julian. It's ridiculous.
Yeah, look, we've been doing this thing for a couple of years. And I remember when we first started off, you said, there's these periods where macro doesn't count. And then there's these periods that macro is the market. And I think we're in one of those periods. There's no question. There's stuff that's kicking off. And I think when you look at it, it's potentially just the beginning of the cycle.
Yeah, exactly right. So what's the big thing that you're focusing? Because we've got a slight difference in views, which is always the good thing, I think.
Yep.
Like, people really enjoy the fact that we have a difference in views. What's your core view right now? And you tend to be slightly shorter term than me, and I tend to be slightly longer term, although we both think in the big picture macro environment.
Yeah, I think, that's just to emphasize for everyone, is sort of, if you've got a trend in markets, which is, either up or down, depending on what market, I tend to sort of do a little bit more of this over it, but generally we don't broadly disagree. For me, look, the big question is the recession call, right? Because if it turns out that the US is going into recession, Europe is arguably already getting there. Germany's certainly going to be having an ugly manufacturing-led recession. That kicks off a lot of trade. So, I've definitively been in the camp that we were in a mid-cycle slowdown. I could see the scenarios in which we could create a recessionary environment. But the big thing that's changed for me, which I think has increased the risks considerably, has been the re-escalation of these trade tensions. Now, I know as we sit here on the 6th of September, they're having talks in October, but everything I'm hearing is you're not going to get really substantive progress. There are just some hurdles that are too high. In particular, the Chinese are after concessions on Huawei. That's actually no longer in President Trump's remit. That's really in Congress's hands. He just cannot give. And you're, in that situation, it seems unlikely that they'll buy the agricultural goods, et cetera, et cetera. So I can see the talks being ongoing. The idea of some sort of breakthrough that covers IP, I think, is off the table. I think the Chinese have essentially given up on Trump until the election. So we're looking at a holding it pattern here. And in that environment, I'm afraid that you start to elicit behavior in markets and also in the business sector, in particular in the US. And that's really the driver. Manufacturing and CEOs' confidence is what drives behavior in the US economy. Because remember, and I think it was on one of the Real Vision's interviews, but I'd use a slightly less politically correct phrase to describe this. But essentially, CEO's product is their stock price, right? The stock price is what they focus on. They don't care actually whether they produce a damn thing. And so the minute that their stock price stops going up, it elicits a response in terms of particularly cost cutting. So we look at unemployment starts to get slow. We start to see CapEx start to slow. And we can see both of those already in the data. We just had non-farm payroll. If you take out the fact that there were 25,000 consensus jobs, we were barely at 100,000. I mean, it's not horrible, but the trend is definitively slowing. And so I'm certainly in the camp that I think that the Fed needs to react pretty quickly. I think that has implications for the bond trade. I think it has implications for the precious metals trades. And I'm not super bearish on equities yet. I think there's some sectors that you can go short. We've discussed with people about banks. We've written about that. I think that's a great hedge for this potential recession race to zero. But look, I know you're much more bearish on the economy.
Yeah, I am. And because I look at the projected path of economic growth, I look at stuff like the ISM and the ECRI survey, and the ISM, a couple of days ago was bad. And the new orders component is at a level that is pretty much a single tick below this level would be almost 100% confirmation of the recession. I think we are really slipping into it. And if I listen to what's going on with, as you said, the CEOs, these people are freezing spending around the world because they don't know what to do. So they're saying at least let's freeze spending until the US election. So that bakes in the cake a recession. I also hear from various people that China just wants to push the Hong Kong situation and the trade talks away from the date of the anniversary of the CCP, which I think is on the 1st of October, and therefore just to depoliticize that stuff and just kick it past that, and then they can start again pushing back. So my view is that we are going into recession. I think the Fed are wildly behind the curve. I think the Europeans have got themselves into a huge mess, and I think we'll talk about the European bank doom loop as well. But I don't see how the Fed can go into this without cutting rates to zero and fast. I think they're going to potentially make a mistake yet again next week, where they probably cut 25. Right. And the dollar screams higher.
You see, so that's when you come down to the trading thing. So look, to me, Powell's made it very clear. He said categorically, number one priority, extend the cycle. Okay. Now, if you take the guy at his word, what does he have to do to extend the cycle? For me, it's basically threefold. Firstly, you have to get stock prices up, not even sideways is enough, right? As I said, minute stocks go sideways, CEOs stop employing people and start to cut capex. So you basically need stocks to continue to go up. We have to keep building the bubble, how ridiculous that may sound. We need house prices to be up or stable. We can't allow them to falter. That's been one of the things that's been weighing on housing activity, which is a big component of GDP. And finally, ideally, we need the dollar to fall. You know, this very strong dollar is a problem. It is disinflationary, and we ideally want the dollar to fall. We want to get the conditions that are very similar to early 2016 when Janet Yellen reversed, the dollar fell, we kicked off the cycle of growth again. The problem is that the more the Fed prevaricates, to your point, Raoul, my concern is as well, they're only going to do 25. I think they should do 50. The debate, we put out a chart to the institutional client base midweek after the ISM number and said, at this level of ISM, which is 49.5, the Fed has always eased in the past, always, categorically. And so we know they're going to ease, but the point is that's actually a big deal from a Fed perspective because central banks are not like the market. They don't flip around, right? They have these long, laborious conversations. They look at their models, they look at the data, and they're very slow. But once they start a cycle, they generally continue it. But we've had a bunch of people, and I actually think quite respected people like Rosengren, question the need to ease at all. ISM should end that conversation, right? So it now should be a question of how much to ease. My concern, which is a little bit like yours concern, is they're still moving relatively slowly, okay? I think they need to do a cutting cycle. I think they need to cut 100 plus basis points. I'm not saying necessarily to zero. I'm not quite in your camp yet. And the reason why I'm not there yet is I'm hoping that is enough to start to weaken the dollar. And once you weaken the dollar and take the edge off the dollar, you get oil price inflation, commodity price inflation, copper goes up. All of those positive signs start to kick in. And I'm hoping they can avoid going down negative rates.
And I understand that people are saying they've got problems with my sound. I'm trying to speak up a bit. But I understand that, but as you and I talked about, there is something really big in those dollar charts, the long-term monthly charts, that suggests that, and monthly charts are not easy to trade from, as we all know, but it does suggest that there is potentially a gigantic dollar move to come. Now, maybe it's a self-reinforcing issue that as the world turns to shit, the dollar is unstoppable. Right. And if I look at the ADXY chart of Asian currencies, or I look at the CRY, CNY, the Chinese currency, or I look at the Brazilian real, or I look at the euro or the pound or the Aussie dollar or whatever it is, or even the Korean won, something looks really problematic. That I think your view of the rate cuts, blah, 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 okay, great. I think that's a reasonable probability event. but the tail is so big that if the dollar does explode higher, I mean, my personal view is I think US rates are going negative, and I can't really quite put my finger on why, but it's.
But look, I
that's
bitterly bloody hope you are wrong. I mean, I've written for Macro Insiders a whole piece on why negative rates are an absolute fucking train wreck. Excuse my French. And it's a black hole that you do not escape from, right? You do not escape from. And guys, if you're looking for a trade when it comes to negative rates, my personal preference is short US banks. There is no reason, these things having been the best performing banking sector on the planet, bar none, that these things shouldn't fall to the same sort of levels that we've seen in Japan or Europe. On, whether you want to do it on a spread basis against the S&P, I don't care, but that is definitively, if you're looking for this trade, these things are going to get tarred and sodding feathered.
Yeah, and I think that's right. And just to go back to this bond trade as well, is I know a lot of people think it's overdone, and you yourself think it's somewhat overdone. Give me your view, and then I'll give you my view, because there's a subtle difference, which I think.
So look, I mean, I think, as I said, we tend to be a little bit more tactical. Our preference at this point is not to play the outright short at the long end of the bond curve, is actually to play what's referred to as steepeners. So we're basically long the short end and short the long end, and we look for that curve to steepen. And it can actually happen in an environment where yields fall. Okay, but the advantage of that trade is it gives you potentially a two plays. It gives you your scenario, Raoul, where the Fed goes, oh my God, and really hammers it down to zero. And then what will happen is the short end will collapse yields, and then the long end will stay roughly where it is, and you'll steepen the curve that way. And the other thing that it will do is, let's say the Fed goes 100, right? And the dollar starts to suddenly slide and commodities start to take off and the long end comes under pressure, right? Because you start to talk about inflationary, which is what happened in 2016. It gives you also that play. So it's not that I'm brutally disagreeing. I am worried, I must admit, about duration exposure. So how much bond exposure basically investors have bought. There are absolute historic highs. I do worry about these central banks disappointing, and then you get a sell-off at the long end. Maybe it's only transitory. But right here, right now, my preference is to play a steepener both in 2s, 10s and also in euro dollars. It's a subtle difference, but that's kind of my preference. The big rates go to zero trade, right? And the one that we're up, certainly on the GDX, like 50% in a month or two, and on silver and gold, 25% in the same sort of period, are the precious metals. To me, if they really are going to zero, then this is just the beginning. I mean, they're getting close to being a little overbought short term. We took some profits on the trades that we recommended to people 6 weeks ago, but this is the foothills. If this is zero, it really, and you know that, right? This is the foothills.
Yeah. So I am incredibly interested in how big some of these trades potentially are, right. And that's the point. Is why I think it's one of the most exciting macro times. Is that, as you said, this gold trade, if we are right in some respects, and gold works in two scenarios. Yeah. Gold works in a reflationary world, and gold works in a deflationary world. In that situation, gold is going to explode. So it is a great, great high quality trade. On the bond side, I understand that the market's quite positioned, et cetera, but having traded a number of these kind of going into recession bond bull markets, usually what you find is you can't buy back in because you're always waiting for the bigger pullback. Right. And before you know it, they don't pull back. And I think there's a risk that this thing goes further and faster than anybody expects. And you will get some nasty pullbacks en route, but it just tends to go up without anybody participating. And I'm still incredibly bullish, mainly on the front end. the 2 years and the euro dollars for next year. You know, I get the steepener trade I like anyway, because it suits my view and your view, which is why the steepener trade is like gold. It's just a great trade. And the euro dollar trade is a fantastic hedge to anybody's portfolio, because you can get such enormous risk rewards out of it.
And I think, look, short the US banks on a relative basis is also a great hedge, right? I mean, to me, that's just, people talk that they trade off the curve. They don't. They actually trade off the level of 10-year yields. And if you're right, and we get that sort of parallel shift, albeit as it steepens in the curve going down, these guys are going to get absolutely screwed. I mean, you know, I've talked to clients who've said, oh, well, you know, the ECB is going to introduce tiering and it's going to help, you know, the European banks. Well, the reality is, when you actually talk to the bank analysts, they talk about, you know, as assets roll off these banks' balance sheet, because they're constantly living beasts, over the next 3 years, they're going to lose all these high yielding assets that are sitting there, legacy assets. Their profits drop 25 to 30%. These things become utilities. They're done.
So that leads me into the European banks doom loop. That's a really interesting situation as well, is the fact that situation has been happening in Europe. So these lending have rolled off to lower rates. Their margins collapsed. The prices collapsed. They have liquidity problems anyway. Yep. They're not lending enough money. Okay, so that's that situation. And then bunds go massively negative.
Right.
And the more negative they go, the less profits the banks earn, the more the share prices fall. Okay, we understand that side of the doom loop. Then I figured out another side of the doom loop, which is that obviously the European economy is slowing down as well. So that starts slowing down the bank share prices and has to price in some risk there. And then the final part of it is that the banks themselves, it becomes a complicated situation for them, because corporations in Europe can't put money in the banking system because only $100,000 is guaranteed. Everything else acts like a short put, because that's called the bank bail-in laws. So if a bank bails in, you as a depositor lose your money, which is a big change. So every single corporation in Europe, let's say you're Siemens, what do? You have to buy bonds.
Right.
So they're being forced to buy bonds. And the more the banks and the more that they buy bonds, it lowers the price of bonds, which lowers the price of European bank shares, which increases the probability of the banks going bust, which increases the probability that Siemens has to put even more money into the bond market. The whole thing is totally fucked.
Yeah.
And it just worries me that the ECB have no control over this doom loop.
Well, I mean, look, we've written to people that this sort of groupthink that goes on within central banks is nigh on sort of incest, right? I mean, it's breeding the same sort of dumber and dumber kids every iteration, right? If they cannot see that negative interest rates do not frigging work, right? And you can see definitively, we wrote about this, you look at Germany, right? It used to be the German savings rates and the ECB's deposit rate used to move hand in hand. So in other words, as the interest rates would rise, Germans would save more. As it would fall, they would save less, until you hit negative. Right? And negative rates are a tax on savings. And if you're wealthy, that the Germans are, that's what you do. You save a chunk of money for your retirement. Now, if you're Greek, you haven't got any money to save. But if you're German, you do. And the minute that happened, is those savings rates increased. Well, that utterly undermines the efficacy of lowering rates, because what you're trying to do is bring consumption forward. Okay. The second thing that you do is you should perpetuate this disinflation. There should be no bloody IFT, Lyft, Uber, and all these other, companies that are sort of challenging the existing marketplace if it weren't for super free funding, right? So this policy is just perpetuating this negative cycle. And I think the only central bank that can possibly deliver is the Fed. And as I've said, if Powell is serious about doing this, he has to keep the equity market up, keep bond yields down, because without that, the housing market's going to roll over because house prices are too expensive. And he has to weaken this dollar. To me, if he can weaken this dollar, and I understand where you're coming through, Raoul, we haven't got, shorts in the dollar. We haven't recommended those at all, okay, at this point. But if he can weaken this dollar, things do change. And then I hope then as we move into 2021, we can get some fiscal spending. I am very worried about your doom loop cycle, because I can see that this perpetual down cycle becomes self-reinforcing.
So that leads me into why the hell does anybody want to own any other currency but the dollar? And that's, there's this whole situation that I think plays into dollar. And you and I have talked extensively for a long time about the dollar shortage.
Yep.
And then we've got this special technical situation that's coming up over the next couple of months. Do you want to explain to people a little bit about that and how that could potentially force the dollar higher and create some issues elsewhere?
Yeah. So, I mean, you're the ones who've written about this, but essentially to make it very simplistic. So as we ran into spending restrictions in the US government, they started to draw down on this sort of piggy bank that they have within Treasury, and they drew down this cash that they had to keep the government going. So once you agreed on new spending limits for the US government, it is now time for Treasury to increase its piggy bank holdings. And that is a large amount of money. I mean, you've got the exact stats, but it's a very large amount of money. It looks like it kicks in from the middle of this month.
Yeah, I think it's $600 billion of tightening comes between now and the end of the year.
Right. So the way that it works as a tightening, though, is the following. The way that central banks used to run policy in the olden days was what they called open market operations. So that what would happen is a central bank would go into, and the one we both learned was about, the Bank of England, right? The Bank of England would turn up at the stock exchange with bills, and they would sell those bills to the banks, and they would extract money out of the system. Okay, and that money would get parked with the central bank, and it would reduce liquidity. Likewise, if they wanted to put money into the system and ease rates, they would, do the opposite. So that's essentially what Treasury is going to do. They're going to drain cash from the system. Now, there's what potentially the Fed could try to offset that. We had a discussion about this at more length in Macro Insider's Insider Talk yesterday. But it definitively is a risk, because we, and I know you are too, are huge, huge believers that the cash in the system is what sets markets. Right, the level of cash seems to set equity markets, and the rate of change of cash seems to set bond yields. And so it is going to be singularly important to see what happens. And that's why I think, we're both very defensively positioned as we move into this typically September, October period, which frankly, if there is a shit show time of the year, it's now.
Yeah, so I'm looking at this situation. We're going to go to the Fed where they cut probably 25. I'm also hearing the pushback against Trump from the Fed means they don't want to look like they're being forced to cut more. So you cut 25 basis points, and in September they start this tightening from the Treasury General Account, which ends up being absolutely enormous. And if they're not careful, they're going to set the dollar off on an explosive move higher, and they're going to force the bond market to rally like crazy, because they're going to have to cut rates enormously.
Right.
So a lot of the people in the plumbing system that I know who look at this situation think that the Fed basically have to cut, as you say, at least 100 basis points and probably have to return to QE to even offset it. So we've got a big problem coming. So I think it's a very interesting time coming up right now in how this is going to play out. So I think the probability still for me is the stronger dollar. Because the Fed really aren't moving fast enough, even to bring into your counter argument, which would be maybe they start moving fast enough to weaken the dollar. They're just not doing it.
Right.
So in which case the dollar's going to explode higher, and bizarrely enough, I think gold goes with it. I mean, you're up in your gold trades for Macro Insider about 50% in a month or something crazy.
Yeah, it's one of those things. We talked about it, and we talked about it over the last couple of years. We've said, I started my career trading precious metals, right? And I've never kind of been a fan, I'll be honest with you. I think it's very archaic. I've never quite understood, this gold bar thing. I've got clients who say to me, it's the end of the world trade. And I go, no, mate, the end of the world trade is lead and brass, because when those are in a bullet, I can get all your gold and shag your wife, right? But the point is starting at the end of last year, we really started to get more interested. We said to people, you maybe should have a little bit of gold and silver in the portfolio. And now, you know, that's coming to fruition. We've taken a little bit of profit on some of the trades. We hit, you know, big targets on those run-ups, and the trades work absolutely perfectly. But on any dip, to me, let's say we get a bit of a dollar squeeze, precious metals come off a bit, I'm a buyer, because it's short-term pain that the Fed is going to have to respond to, right? They can't allow, to my mind, they can't allow this dollar to go too far, because it'll be totally destructive, right? It'll be totally destructive, Raoul. Now, can they stop it? I don't know. But
that's the problem, Julian.
I get you. I get you. But then they're going to try. They will try, right? They will cut rates. And in that cutting of rates to zero, right? Let's say you're right. In that cutting of rates to zero, these precious metals, to me, just go again, because they're destroying their credibility. So look, stop, you know, a little bit, take some profit, which we've done. Positions, I think, are extended. You know, you go through in macro, and I think this is one of the things just to stress to people. We come out with these flash updates where we say, this is the trade, it's here, it's now, get on board. Okay. And then you could have months of nothing, right? But when the flash updates tend to happen, they tend to be like bang, 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 bang. The very reason that that's how macro works, right? Most of the time, equity markets go up. Most of the time, bond markets are benign. Most of the time, we have big trends in commodities. Most of the time, we have a big offsetting trend in the dollar. But at those inflection points, that's what drives markets. And that's what we're trying to do to people. That's what we're trying to help you manage.
Yeah. And, you know, the other part of what we managed to do so far is, you know, we managed to get that bond trade absolutely nailed for 9 months now.
Right.
And, you know, and both you and I spend a lot of time discussing what we think is going forwards. And I think the dollar is something that I think we both are very focused on. And there's other aspects of the market. I think shorting the equity markets is something we're looking at. I've been short the commodity markets as well. So I think there's a lot to come. It's one of the most macro environments I've ever been in. I think it's probably maybe a good time to talk, to get some questions from people who are watching this, because I know there's, 900 people watching this. So the question,
there's a couple of questions come up, I presume, from Brits who are on here, expats, not expats like you and I, but essentially talking about the UK and, you know, is it a good time to be putting money in? And this is not something that we've really addressed in a way in Macro Insiders, in part because it's so very, very difficult to model this political outcome. I've never been overly bullish on the situation. I've got colleagues, you know, who's still in the UK, and they're all, you know, cockahoots, and they were like, oh, it's going to go well, everything's going to be fine. And I was like, I don't think this ends up particularly well. And as I look here at the moment, we've obviously just got Boris Johnson's just got put in a box. The two outcomes that I feel, we're going to have a general election. It's just a question of how we get there. That seems to be the most likely outcome. And for me, that becomes a binary outcome, and neither of those are particularly sexy. The first one is that Boris Johnson has to swing very hard into the Brexit camp. He has to truncate Nigel Farage's chances of splitting the Tory vote. And to do that, he could make a pact with Farage, but Farage doesn't really trust him. My bet is he just swings really hard and campaigns definitively on a Brexit vote. So you vote for me, we're out. That's it. Okay. The second risk is that if he loses, we get Corbyn. And guys, I mean, there was a story this morning about, you know, the shadow chancellor, Labour chancellor, talking about, you know, cancelling all bankers' bonuses. But that's the least of the concern. This guy is an out and out Marxist. And if you think hard Brexit could push us down to sort of 105 in cable, which is probably what my guess, you know, maybe you hit 1. All right.
Well, I think it goes to parity.
Yeah. Okay. I mean, look, you know, you're splitting hairs at that point, and I'd probably be a buyer at those sort of levels. Okay. Corbyn, right through 1. Right through 1. Right. You're talking a guy whose probably closest political ally was Chavez in Venezuela. This guy is a
So there's a great question somebody's just put up, is how do you hedge this? Because the option market is already so skewed, it's difficult to find a way of hedging this trade. What is it?
My guess would be probably certain stocks within FTSE, right? Because they're very, very international focused. So if you get a blindingly collapsing cable, you should get a relative outperformance of FTSE. I would think that my concern, and that might actually benefit as well from sort of as a capital flight trade, because the big risk is, the UK lives off borrowed money, right? It's like the US, right? It lives off borrowed money, and that's FDI from the Kuwaitis through to, US guys going in there and buying houses in Hyde Park, right? That's what we need, that for the current account deficit. And so sterling can get really bloody ugly in a Corbyn type situation. And I think you're going to buy, gold in sterlings would be a great trade. Silver in sterling would be a great trade. But I quite, and that's why I think, one of the things that we'd said to for Macro Insider people, we'll look at this. If you're in, euros, if you're denominated a euro investor or a sterling investor, look at these charts, or a dollar investor, look at these charts.
So another question that's coming
UK
up,
stocks and gold and precious metals, I think,
is people are interested in the US stock market. Neither of us are particularly, we're not bearish. We just think it's the lower quality trade. If there is a quality trade, it's the banks. I also like short the oil companies as well on a more structural basis. But it's not something either of us are massively encouraging yet, because
we've had stabs at it.
Buyback mechanism and sorry,
we've had stabs at it. I mean, last September, right, we took a big negative view on these FANG stocks, right? And we sent it out to everyone. We said, watch Netflix, watch Amazon, watch Nvidia, right? And we said we'd have shorts in these things because they look, you call it a crash pattern, I call it a classic bubble. Okay, these things are incredibly stretched. And we got that right. But you're right. I mean, a structural short in the US equity market has been very difficult, right? We've run very, very simplistic trading models on the S&P, and generally they've worked. And we told everyone back in the summer that they were starting to turn up again. We had a little wobble, but we said on balance, you're probably supposed to be, long the broad index. Within that, to your point, I think the bank, if we're going into recession, and as I said, I think the Fed could head it off. Are they doing what is necessary to head it off at the moment? No bloody way. Okay. My fear is that they're not, if this trade talks now are on, which we don't believe, okay, but they're on, you get this period where equities are okay again, and then the Fed goes, well, I don't need to do much. Right? I don't need to do that 50. I don't need to do that huge cutting cycle. So we go through this churning period. And as I said, the longer that pans out, the greater the risk that when they do get that moment where they go, oh shit, right, that rates have to go to zero. And as I said, that's why I don't like the banks. And so, but it's not to me that broad sell on the equity market. I haven't got the setup yet. I'd love to do it. But look, I think what people don't understand is every single macro trader, which basically means you're either FX or bonds, okay, would love to take that glass half full, smash it on the side and shove it up the where the sun don't shine of the equity market, right? We've learned, you just don't do that, right? You have to manage your portfolio, and managing your portfolio at the moment means that you're still long, US equities, but with some hedges in other things.
Yeah, so I think, and look, I think it's going to be interesting to develop. I think also a lot of people aren't that familiar with Macro Insiders and the product itself. I don't know if you want to just give a bit of an overview so people understand what it is we actually do.
Yeah, so we started this, what was it, 3 years ago? Two and a bit years ago. And the idea was to have an interchange of views that we could push out to the retail client base, right? So the sort of active trading client base. And it would be, there would be definitive trades. We started to put out now a portfolio essentially of our views of where we think you should get out and stops and so on and so forth. But really to take things a step further than you do in Real Vision, right, which is unscripted. This is really to help you guys and talk directly to you guys, answer questions. We've got a bulletin board where people can ask questions, and we do spend time, not always, instantaneously, because we're on the road talking to clients and doing stuff like that, but we do talk directly to you guys. And it's that interchange of views, because we've got, as macro people, quite similar long-term structural views, but that interplay of ideas. And I know it's taken some people some time to try to get their heads around, oh, wait a second, Julian's bullish, Raoul's bearish, but it's not. It's frequently time things, and to really help and appeal to people to manage their money, right?
And, I'm really proud of what we did, actually, and just because we aimed to, we both got institutional products, which are super bloody expensive,
Right.
and we just wanted to get a product for other people to give people with smaller or lesser experience or less money a chance to do what the biggest hedge funds in the world do, those kind of trades. And it was really interesting, the journey of this, because in the beginning, everyone was like, what the fuck are you doing? You guys, you're not doing any trades. There's nothing going on. You're never going to make money. And we kept saying, macro doesn't work that way.
Right.
What you know is a crappy newsletter where people just pump ideas. Macro works by building a framework, understanding, doing your homework, and then it all happens at once. And yes, you will have a few attempts at it and you'll get it wrong a few times, but the macro picture works. And it's played out really, really well. I've been really, really pleased with that. So I think it's good. Kim, do we want to move forward to, you want to say about the pricing? So if anybody is interested in these views, we do these videos every month as part of it. Julian writes a piece, I write a piece, and then we have a piece that comes from my Global Macro Investor institutional product and Julian's MI2 Partners institutional product. So you kind of get what all the big hedge funds get, as well as all of the thinking of Julian and I. So, Kim, do you want to talk a little bit about some of the product offering, just in case anybody's interested here?
Yeah, so we actually changed up the pricing a little bit more for macro insiders to make it more affordable and more able to be accessed by everyone. So there is 3 new pricing tiers for macro insiders, and if you are interested in seeing what those 3 pricing tiers are, we do have monthly options, quarterly options, and annually option. And you can click on the link that was just sent out to everyone to see all those options. And I would say thank everyone for coming and joining us on this, webinar today. And any final thoughts from either Julian or Raoul?
No, I just
go ahead, mate. You go.
Incredible. It's an incredible macro time. So I just think it's time to focus. It's time to either be careful of the risk that you're taking, or if you're a macro guy like me or Julian, it's time to make a lot of money. I think that's the potential that's out there. Julian?
Yeah, no, as I said, I think you said it well. There are times where you have to sort of justify your existence as a macro guys, and there's sometimes, because there's not much going on, and everyone just buys equities or just buys bonds or whatever. But this is definitively the time. And you can tell that by, the amount of flash updates or sort of trading recommendations we put out. And I think those are only just going to increase in the next few months. And hopefully the track record that we built, since the start of the year, in terms of whether it's fixed income, whether it's your dollar career call, whether it's gold, silver, whatever, I think it's just going to build over this year as we see these central banks tie themselves in ever greater and greater knots.
Yeah. So thanks everybody for joining us. I hope you enjoyed it. Julian and I always have a lot to talk about. We don't always agree. We have different time horizons. Sometimes we really disagree. Other times we really agree with each other. But that's where all the value lies. Anybody who tells you that the world is a simple place of buy and sell recommendations doesn't know what the world is really about. So anyway, thanks so much for joining us, and we wish you a lot of luck in these markets.
Yep. Thank you everyone for coming. Have a
good day. Thanks. Right. Are we all done?